It's now time for Global Insight, where we speak to experts from around the world on issues making headlines. On Wednesday, the US Federal Reserve raised its benchmark interest rate by an additional 0.75 of a percentage point. Now, this is the fourth time that the central bank has raised rates this year, amid record high inflation of 9.1% in June, which is the highest in 4 decades. With monetary tightening at a much faster pace than previously expected, various indicators such as property sales and a falling stock market are leading to hope that aggressive tightening has been slowing the economy down. But has it been working all too well to the point of a very imminent recession? And what about the South Korean economy, which has also been experiencing surging price levels and rate hikes? For this, we invite Randall Krosner, Professor of Economics at the University of Chicago Booth School of Business, and Professor Kim Se-wan, Professor of Economics at Ewha Women's University. Very warm welcome to you both. And my first question to you, Professor Krosner. Now, it seems that Fed is trying to dampen demand as supply-side factors such as the supply chain issues that we're experiencing and the war in Ukraine, of course, they seem to be slightly beyond the Fed's control. So do you think this aggressive pace of rate hikes has been working? And do you agree with its latest decision to raise rates?
Yes, I agree with this decision. I think it's very important that the Fed make sure that inflation expectations do not become unanchored and get out of control. That's what happened in the late 1970s, early 1980s in the U.S. The last time inflation was this high 40 years ago, and the Fed had to raise rates to double-digit levels. Now, hopefully, they can raise rates just 4% or so, and the inflation will come down. And that's why it's very important that they act aggressively and act now, even if they are not the source of all of the price pressures. They own it. They are the central bank, and they're the ones who have to deal with the inflation.
And Professor Kim, there have been growing concerns about a possible recession. Some people think we're already in a recession. And addressing these concerns, Treasury Secretary Janet Yellen, she said that the US economy is in a, quote, period of transition in which growth is slowing, but not yet in a recession. So what's your point of view? And at what point would you call it a recession?
Well, Ms. Yellen has a strong incentive to say no to recession possibility as U.S. Finance Secretary because people are affected by her speech. But she acknowledges that U.S. economy is slowing down. Recently, she said that there is a path to avoid a recession in a news interview. And as an evidence against recession, she emphasized a strong labor market, which added over 370,000 new jobs in non-farm payroll in June, along with 3.6 unemployment rate at the near full employment. But at the same time, U.S. initial unemployment claims increased last week to 250,000, which is the highest in the last 8 months. Also, the majority of economists in markets and academics agrees that the recession possibility is higher recently. So overall, it is too early to say that U.S. economy is under recession because signals are mixed as of now. But it is true that U.S. economy is losing steam of economic recovery and becomes closer to the recession.
Professor Krosner, report from the Bank of America says that the US is going to have a mild recession in the second half of 2022. And some are now warning that there's going to be a double dip recession. What's your outlook?
So I think we're gradually going to see less economic activity, and so I think the unemployment rate is going to be moving up, and the labor market is starting. We have signs of it starting to weaken, and I think it is going to weaken. It is going to weaken further. Whether it'll be a formal recession or not, we'll have to see. There's a committee of people at the National Bureau of Economic Research who make the formal definition, make the formal call of whether it'll be a recession or not. They tend to focus a lot on the labor market, and so it'll really be a lot on how the labor market evolves. Right now, given how tight the labor market is, I wouldn't really call it a recession, and I don't think they would. If the unemployment rate starts to go above 5 or 6%, which may well happen by the beginning of next year, then I think that's a possibility, not a necessity.
And Professor Kim, while turning our attention to the South Korean economy, which hasn't been faring so well, of course, with households in debt, surging levels of debt, and our own rate hikes being ongoing. And well, do you think the South Korean economy is also in danger of slipping into a recession? I mean, what kind of concerns should we have at this point?
Korean economy is expected to expand over 3% only this year, but as unfavorable external factors of higher oil price, war in Ukraine, and U.S. Fed's aggressive interest rate hikes go on, Korean government adjusted its this year's economic growth down to 2% level. We know that 1% economic growth decrease is a big drop. And then Bank of Korea should be keeping step with U.S. Fed interest rate hikes to avoid capital outflows from domestic market. But higher interest rate already gives negative impact on domestic consumption and investment. In the second quarter, Korean economy had a robust economic growth of 0.7% on quarter. But if we take a look at the details of it, we have some concerns. The strongest recovery momentum of Korean economy, the export is weakening due to China's slowdown and higher production cost. In the second half of this year, households' consumption, which sustains Korean economic growth, now just down to a much higher rate. Then Korean economy's expansion for this year could be declined to 1% level.
Right, we're sorry about the slight lapse in audio there. Professor Krosner, well, some believe that a mild and short-lived recession might actually do the US economy a bit of good, really slowing it down. But the cut in figures, though, it also impacts people's jobs and livelihoods. And do you think the pain really will lead to gain for the US economy? And if a recession does occur, then just how big will the fallout be?
For sure. I mean, I think the Fed understands that they would love to be able to avoid a recession, but as the chairman had said, it's very important to bring inflation down, because if we don't bring inflation down, we don't have a solid foundation for a long-term economic recovery. And so there may be need to have a short-term slowdown or even a recession in order to bring inflation down, in order to avoid what happened in the late 1970s, early 1980s, when inflation got so high and inflation expectations got so high, the Fed had lost credibility, that they needed to really crunch the economy in order to bring inflation down. I don't think we're in that situation. I think we can have hopefully a softish landing that is just a very slow growth for a few quarters rather than actual contraction. But I think workers will understand that although in the short run it may be painful, in the long run it's much better, because the jobs will come back more quickly and you don't get as sharp a recession as we did in the early 1980s.
And speaking of the softish landing, Professor Kim, Fed Chair Jerome Powell, he hinted that there could be a soft or softish landing for the US economy amid a series of rate increases. And well, what would be a soft landing, and what does he mean by softish?
I don't think we have an exact definition of softish landing, as we don't have it for recession. So we can interpret Mr. Powell's softish landing along with Finance Secretary's recession, like evidences say that U.S. economy is better than the former recession for sure. One of the largest concerns of the U.S. Fed's operation to tame inflation would be serious recession or hard landing. Related to this, we can relatively describe the softish landing in data perspective. For example, U.S. economy is expected to grow over 2% for this year, but growth decreases down to 1% level. That would not be a softish landing. Or if labor market adds less than 200,000 payroll on month, that also would not be a softish landing, but a hard landing.
Well, Professor Krosner, now Mr. Powell said that he intends to bring the inflation rate back down to the 2% level. And well, what do you think the Fed's next steps are going to be to achieve that? Do you think they're going to start slowing their pace a little bit, or will they continue with their aggressive mode?
I think they're going to continue tighten policy and raise interest rates, but I think it's unlikely that interest rate increases will be as high as they have been in these last two rate hikes. It's been 0.75 of a percentage point in each one. I think it's more likely that we're going to see some better numbers for headline inflation because energy prices in the U.S. have come down a bit and some food prices have come down. Probably what will happen in September will most likely be 50 basis points, and then there are two more meetings for the rest of the year of 25 basis points each, 1/4 percentage point each, and that gets you to around 3.5%. Probably they will still need to go a little bit further than that to, I'd say, 4% or so, because I think inflation is still going to be reasonably high. But I think they will keep interest rates there for a while. Markets are expecting that they're going to bring them back down very quickly. I don't think so. I think they're going to have to keep interest rates at around 4% or so for a while to make sure that inflation moves back down to their 2% target. That's not going to happen quickly. I think inflation will come down relatively quickly from the 8 or 9% level down to, let's say, a 4% level or so. But it's going to take a while to get back to the Fed's target of 2%.
And Professor Krosner, while talking about the recession fears again, if there is a recession, then, well, how do you get out of one?
So that would be the Fed bringing interest rates back down, pivoting. So after they've wrung inflation out of the system, and after they've made sure that inflation expectations are well anchored around their 2% goal, they can start to bring interest rates back down. That provides more liquidity, that provides more funding opportunities. It makes it cheaper to borrow, whether it's to buy houses or to invest, and that would be one of the tools. Another tool will be on the fiscal side, more incentives for investment, so give better tax incentives for investment, and potentially some spending on different projects that may have a very good payoff for growth.
And Professor Kim, over here in South Korea, well, consumer sentiment is quite pessimistic. It's been going down for a couple of months, and many expect the economy is just going to get worse. So how should the Bank of Korea and also the government prepare for a soft landing for the Korean economy amid the continued monetary tightening that we're seeing, as well as slower export growth?
That is the tough question. But actually, since current Korean economic slowdown is generated by most of the foreign factors, Bank of Korea's and Korean government's policies won't be so effective. According to Bank of Korea's report in July, consumer sentiment fell to the lowest level in 21 months, and expected inflation hit a record high over 6% in July amid rising energy and commodity costs. It means that Korean consumers expect that monetary tightening and so many problems like energy prices soaring around the world would lead to a slowdown in Korean economy. Actually, major negative factors in consumer sentiment have been from foreign countries, as we talked about. So Korean government policies won't be so effective in controlling inflation and economic slowdown. But in this difficult situation, government and Bank of Korea should clearly set the policy priority between stabilizing inflation and economic recovery. And it is also necessary for government to explain current inflation situation to avoid rapid wage increase demand by workers.
And Professor Krosner, well, as the US Fed continues to tighten its monetary policy, many emerging economies around the world are looking on with a bit of fear, really, and it does really trigger more concerns about the possibility of capital outflow. And what do you think about the situation? Do you think the Federal Reserve's officials are taking this into account as they continue to introduce rate hikes?
Well, certainly the Fed is aware of the international consequences of its actions, but the Fed, like all of their central banks, are created by their congresses or their diets to focus primarily on their domestic economies. So the Fed understands that as interest rates rise more in the U.S. than in other countries, that interest rate differential means that it's more attractive to invest in U.S. assets that will have a higher rate of return than in assets elsewhere. That leads to capital inflows to the U.S. and outflows, particularly from some emerging markets, and that they take that into account in how that'll affect inflation, how that'll affect economic activity. But the primary focus will be on the U.S. Because that is its mandate. It's to focus on maximal employment growth consistent with low and stable inflation, and that is focused on the U.S. But it will have global consequences, and the Fed is aware of that.
Right, of course. And now that its recent decision is out, I'm sure many economies are now looking to the next one, and already the speculations are beginning. But thank you both so much for your time today. That was Randall Krosner, Professor of Economics at the University of Chicago Booth School of Business, and Kim Tae-han, Professor of Economics at Ewha Women's University. Thank you both so much for your time.
Thank you.
Thank you very much.